So we've looked at some typical business transactions and how those impact the accounting equation. What we have on our screen right now is a summary of those transactions A through H. And so I will let you go through this top portion here. We've already done all of this slide by slide, but I want to direct your attention down here to the bottom. And there's some useful information here that that we've touched on, and I want to clarify a couple of these. Well, specifically this first one. It says the effect of every transaction is an increase or a decrease in one or more of the accounting equation elements. Now, I want you to think back to that second transaction that we had, where when I read the word accounting equation elements, I'm thinking in terms of assets, liabilities, and stockholders' equity. And if we think back to that second transaction, our assets were unchanged. We had $25,000 in cash, and then we went out and we bought land for $20,000. So depending on how you look at it, the mix of assets did change. And so in that regard, this first statement here, this first bullet point statement is true. But if we look at assets as a whole as being an element of the accounting equation, assets actually did not change. So it is possible that, we could have a situation where one asset goes up, another asset goes down. We can actually have a situation where one liability goes up and another liability goes down by the same amount for a given transaction. But something will change. We might not actually see it in the overall number for assets, liabilities, and equity on every transaction. Usually we will, but I just wanted to point out that transaction because I didn't know if that first bullet point might cause some confusion. The second bullet point, it says the two sides of the accounting equation are always equal. I've talked about that quite a bit. It said that stockholders' equity is increased by amounts invested by stockholders. And this is an absolutely true statement. So if we think about it, if we invest, we invested the $25,000, or Chris Clark invested $25,000 in the previous video into Net Solutions. Well, what happened when he did that? Cash went up by $25,000 and there were no liabilities. So let's just say that he decides to throw in another $10,000 as an investment. Well, cash would go up by that additional $10,000 and there would be no liabilities. Therefore, stockholders' equity would have to go up. It says, fourth bullet point, stockholders' equity is increased by revenues and decreased by expenses. That is absolutely true. We had some examples of that. And we're going to look at another slide here in a moment that will kind of summarize it. And then it says the stockholders' equity is decreased by dividends paid to stockholders. Again, we also had that example as well. Okay, so I want to talk about stockholders' equity, the third element of the accounting equation. And we've got two terms here, and we've gone over these already, but I want you to understand that for our purposes, at least getting started, these are the two parts of stockholders' equity. We have common stock, which is simply contributed capital by investors. So Chris Clark, remember, he put the $25,000 into the company. Company got $25,000. He got common stock totaling $25,000 that represented his investment. And then retained earnings. It says retained earnings is the stockholders' equity created from business operations through revenue and expense transactions. The only thing I would add to that, again, is it is the amount of essentially profit that has been realized by a company and has been retained. So think about earnings or profit, and then the part of those earnings that have been retained, that is not distributed back to owners. Okay, so these are the two parts of stockholders' equity for us right now in the course. All right, here's our little summary that we were talking about. It says effects of transactions on stockholders' equity here, and this is a really nice little summary. When an owner invests in the company, stockholders' equity goes up. When an owner takes back some of that money, equity goes down. Okay, because they've removed part of their equity from the company when they get distributions, otherwise known as dividends. Revenues in and of themselves increase stockholders' equity, and expenses, as we incur expenses, equity goes down. Again, pretty common sense type stuff, but you're just getting started in accounting, so we can't take anything for granted. All right. I have alluded to and even talked about these things called financial statements. Back in those first set of slides, I caught myself referring to financial statements, only to realize that you don't necessarily know what financial statements are. Well, here are the four financial statements intended for users outside the company. And we have an order in which they're prepared. We have the income statement, which you have more than likely at least heard of in your life. And it says it's a summary of revenue and expenses for a period of time. And that's precisely true. Retained earnings statement, or the statement of retained earnings, is a summary of the changes in retained earnings that have occurred during a specific period of time, such as a month or a year. This is probably the easiest statement to understand, actually. Even though you don't understand it right now, you will. And we'll also probably spend the least amount of time on the retained earnings statement. But when we consider here in a moment why these statements are prepared in the order that they are, I think we'll understand the importance of the retained earnings statement being second. Number three, the balance sheet. You have probably heard of a balance sheet before, and let's see what it is. It says it's a list of assets, liabilities, and stockholders' equity as of a specific date, usually at the close of the last day of a month or year. So a couple things here I want to point out. We've been talking about the accounting equation in some of our previous videos. I want you to understand that the accounting equation is a balance sheet equation. All right. The other thing I want to point out is that the income statement is for a period of time, but the balance sheet, it says, lists these things as of a specific date, or another way of saying that is a point in time. So income statement is for a period of time, balance sheet is for a point in time. All right. And then finally, we have the statement of cash flows. We're going to go over this a little bit now, and then it'll also be one of the last things that we cover in the course. And it just says a summary of the cash receipts and cash payments for a specific period of time, such as a month or a year. In other words, what did we spend money on? How did we get money? So on and so forth. So let's talk a bit first about the income statement. The income statement, as the previous slide says, it reports revenues and expenses for a period of time. So we take essentially all of the money that we receive from our customers, and then we're going to subtract out from that figure all of our expense items. And when we do that, we say, okay, if we have more revenue than expenses, we have net income or net profit, or simply earnings. The term that we will use in this course is net income. So if revenue is higher than expenses, we have net income. If the opposite is true, if expenses are higher than revenue, we have a net loss. So the purpose of the income statement is to determine net income or net loss for a period of time. Okay, because when we think about this, we were talking about the statement of retained earnings. I'm sorry, I apologize. We were talking about the stockholders equity section, or the stockholders equity portion of the accounting equation, you may recall. And we included this thing called retained earnings. Well, revenue increases retained earnings. So when we start out a business, we have no net income because we haven't operated yet. So our net income is zero. Our retained earnings is zero. That doesn't mean we don't have any stockholders equity, because we might have owner investments. But retained earnings derive from the income statement. So if we make $10,000 and we keep $8,000 of that, retained earnings will be $8,000 for that period of time. Okay? So this is why we have to start with the income statement. Here we have an example of a very, very basic income statement. This is called a single step income statement. And that simply means that we're going to take our revenues and we're going to put them up here at the top, and then we're going to subtract out all of our expenses, and we're going to come up with net income. So it looks like we had total revenues of $27,800 here. We had total expenses, although we had several different types of expenses, but we had total expenses of $14,850. If we subtract the $14,850 from the $27,800, we end up with net income of $12,950. That's because our revenues are higher than our expenses. This is what we want to see happen. Okay? Now, the next item, if you recall from a couple of slides back, is the retained earnings statement. And it says that the retained earnings statement reports the changes in retained earnings for a period of time. Now, the second bullet point is very important. It says it is prepared after the income statement because the net income or loss for the period must be reported in this statement. We'll look at an example here in a moment, and hopefully that will help. And then it says, finally, similarly, it is prepared before the balance sheet, since the amount of retained earnings at the end of the period must be reported on the balance sheet. All right, so let's go ahead and look here. Hopefully we have an example. Looks like we do. We have a statement of retained earnings. So this is for a different business. The first example that we looked at for the income statement was for a guitar shop. This is some other business. So here's our header up here, and notice this is for the end of the year, 2019, December 31st. So what we're saying here at the very beginning of this statement is that retained earnings as of January 1 of 2019 were $400,000. So what is this $400,000? Is that stockholders' equity? Well, yes and no. It's part of stockholders' equity. This $400,000 is the amount of profit that Quartz Corporation has both made and retained since the beginning of time. Whether they've been open for 1 year, for 5 years, 20 years, doesn't matter. Let's say that they've been open for 10 years and they've made an average net income of $100,000 a year. Well, let's think about this. 100,000 times 10 is $1 million. But here we have only 400,000. Because even though they've made $1 million over this, hypothetical 10-year period that I'm giving you as an example, they've only retained 400,000. They've paid out $600,000 in dividends to owners. Owners don't just invest in businesses for their health. They expect to get something back. So this $400,000 is our starting point. And then net income for the 2019 year is $115,000. So we take beginning retained earnings and we add the net income and we come up with $515,000. But wait, the owners this year, they also want to receive some dividends. So we're going to subtract out the dividends paid in 2019. In this case, it's $35,000. If we subtract the $35,000 from the $515,000, we come up with ending retained earnings on December 31st, 2019 of $480,000. So the formula is very simple. Beginning retained earnings plus net income minus dividends equals ending retained earnings. Okay, so very, very simple financial statement, but it is absolutely fundamental, and it is and it has to be prepared second after the income statement. All right, let's go ahead and wrap this video up, and we will finish up the chapter with one more video over the balance sheet and statement of retained earnings.